Joining us now is Stephen Abrams, Managing Director at Trust Company of the West, Peter Schiff, President of Euro Pacific Capital, and Keith Wertz, President and Chief Investment Officer at Fifth Third Asset Management, where he oversees the 4-star Morningstar rated Fifth Third Strategic Income Fund. Gentlemen, welcome to you all.
Great, thank you.
Thanks.
Before we ask you to pull out your crystal balls, I'm going to ask you this question first, and that is because we are potentially waiting for the imminent execution of Saddam Hussein. Is this a good thing for the markets? Keith, start off with you.
You know, one concern would be a reaction out of the Middle East and whether or not that might cause an extended disruption into the supply of oil itself. And I know the oil market saw some price rises as a result of that. So there is some concern about the Middle East reaction to his execution.
Peter?
I think it's a non-event for the markets.
Okay.
You know, I was just noticing, guys, that as that news came out in the later half of the day, we did have a sell-off, although the markets rebounded. Was there any reaction there to that? Keith?
No, not that I noticed, in fact. I think the markets are going to, it was so quiet today, there was so little liquidity, there just wasn't a lot of participation. But the commodity markets, I thought we saw oil price rise just based on the concern itself.
Stefan, let's bring you in. What do you think?
I think it's a non-event.
Okay. All right. Well, let's turn the page here. Look out to 07. Where are we going to see the markets go after this tremendous year in 06, especially as we are seeing interest rates start to tick higher? Right now, the 10-year yield sitting at a fresh 7-week high. Keith, let's start off with you. What are your predictions for 07?
We think next year is going to be a year where the domestic marketplace catch up to the foreign markets, so we're pretty bullish on the U.S. stock market. And as we look at the fixed income side of the equation, we think rates are going to stay fairly stable or flat. And if anything, towards the second half of the year, we think the Fed's going to come back into the marketplace with an ease strategy. And so we're looking for an inverted curve to start to flatten out by the end of the year.
Stephan?
I generally am optimistic. I've said on this show a few weeks ago that I thought 1550 was a minimum expectation for the S&P 500. We are in a long-term capital-friendly cycle. Free markets, free trade, globalization, and the productivity gains coming from technology are all contributing to that. Stocks are reasonably valued, and in the absence of some negative surprise that we can't sit here and scope out tonight, 07 ought to be a pretty good year.
Some pretty good reasons, Peter, but you're the total, I mean, we were discussing polar bears before. We can probably roll that footage because you are the bear out of the three here.
Surprisingly enough, I disagree. And, you know, Steve, I disagree when you said this is the year of the bull. I mean, no one's a bigger bear than me, yet I made more money than anybody this year investing outside the United States because I was so bearish. You know, people are getting excited about the meager returns that the U.S. stock market gave out this year. But you beat that just investing in a passbook savings account in most other countries. And if you were smart enough to be invested in stocks abroad, you really outperformed the U.S. market.
Yeah, but Peter, what was the risk-adjusted returns? I mean, you went emerging markets and you had your ups and your downs.
Well, I'm not talking about emerging.
I agree with you, Peter. I want to give you credit where credit was due because I follow your work here, and I think it's worth saying. You were very bearish on America. I think you would have steered people wrong when it came to U.S. investments, but your overall idea, which was that they were better returns outside the U.S., that was definitely true. My question becomes for next year, does your Dr. Doom scenario finally come to pass where the U.S., for example, has negative returns? You can go on the line on that prediction.
I think we already have negative returns when you adjust it for the real inflation rate or look at the price of gold. But I think we're taking less risk by going abroad. I think there's a lot of risk in the United States. I think there's a lot more risk here than most other developed countries. That's why we're investing abroad.
You know, one thing I would add, Steve, though, if you look at the U.S. marketplace, fundamentals have been stellar. For the last 5 years, we've seen corporate profits expand at a pace of about 18% annualized. And if you look also at the deviation of those corporate profit circumstances, quarterly the standard deviation has only been 7.5. It's hard for me to argue that there's a lot of risk in the U.S. marketplace. We've seen great fundamental conditions here in the U.S.
We haven't seen great fundamental conditions. What we've seen is a bubble. We have an economy that's based on borrowing money from abroad and buying imported products, and we're financing it with the inflated equity in our homes. This thing is going to turn around very quickly. We're going to be in a serious recession in the United States, and all those profits are going to vanish.
Peter, that's what you said last year. It didn't come to pass, and plus, it seems hard to have a bubble, Peter, when corporate profits are as high as they've been. Stephan Abrams, are you buying this negative returns when you factor in inflation and or the price of gold?
I don't know how you can take a 16% return on the S&P and subtract a 3% inflation rate and get a negative number, but maybe somebody can do that.
Well, first of all, I don't believe the 3% inflation rate, but The S&P did 16% this year?
With
Just about.
dividends.
S&P did 13.6, well, just
With
with the stock market, right?
dividends.
Exactly, and with
Yeah,
dividends.
so you might have
With
barely
dividends.
eked out. You might have eked out the inflation rate, but you
It's
certainly
not
underperformed.
eking
Gold.
out. I mean, what do you think is a 10% inflation rate here, Peter?
Look, I'm not believing the government's
Peter, I
numbers.
gave you lots of praise before. Don't turn this into something bad.
Look.
You were right. There were better returns in Europe. There were good returns here in America. It just strikes me
look,
that you're going a little bit too far here.
I disagree that the returns are good. Look, the price of gold was probably up 24-25% on the year, right?
All right, we're going to leave it there.
Stay there.
Guys,
Stay
stay
there.
right
We'll
there.
come back
Everybody
to
stay right here. Up next, our
Hold on.
Market All-Stars will talk about profits, big profits in 2007. In fact, we cross our fingers right here at Kudlow & Company.
We are back with Stephen Abrams of Trust Company of the West, Peter Schiff of Euro Pacific Capital, and Keith Wirtz of Fifth Third Asset Management. Everybody has at least 3 words in the title of their company. Let me start off here. Let's get really bored down here and get some predictions for 07. Stephen Abrams, one concern I have for next year, corporate profitability has been as high as it's been in what? The post-war period. Can that continue? There have been predictions quarter after quarter that these high levels of profits would fall. Will it finally happen next year?
Well, I don't foresee a recession. And in the environment I'm looking for, which is subpar growth, the rate of corporate profit growth will drop from what it's been the last year or two, but I think we'll have a respectable high single digits gain. And if interest rates behave themselves, that's an environment in which the market can go higher.
Give us some idea of some of the stocks on your radar list for next year.
Well,
Stephen.
I like all the global infrastructure plays, and there's a large number of those. I like energy broadly defined, particularly oil field service and alternatives from nuclear to coal to solar. And I like defense and homeland security plays.
Yeah, we're going to talk about energy plays in the next segment coming up. Keith Wirtz, take your macro play and relate that to specific investments that you might be making next year.
We share the same view that Stephen just articulated. We think that next year we're going to see growth moderate back towards more of a trend-like condition. We also think the profit expansion will start to moderate as well, maybe towards that 10% kind of level. But if you look back in history, Steve, it's not unusual for the stock market to rise as long as earnings don't actually contract. And usually the main dominant force on the stock market is interest rates. And as we see things next year, interest rates are going to stay fairly benign, in fact, if not dropping to lower levels before the end of the year. And as we look in that condition, we're thinking P's expand and you want to stay domestic. And our themes next year are going to be large cap, and we think growth is going to assert itself for the first time in maybe 3 or 4 years.
Large cap's a little broad, though, Keith. Give us a little more detail.
When you think of large caps, we do like the infrastructure plays, as Stephen likes. We like companies like General Electric, Emerson Electric. We like, in the technology space, Microsoft and Cisco Systems. These are going to be large cap quality names that we think are going to assert itself in a moderating kind of environment.
Peter, if the sky is falling in 2008 potentially, how do you invest?
Or maybe 2007.
Maybe
I still
2007.
think the major risks facing the economy are still the dollar, interest rates, and the housing market. In many respects, the 3 are all interrelated. But I do think there's a significant risk that foreigners finally pull the plug and let the dollar drop. And that has massive implications for interest rates, for consumer prices, for housing. I think those are significant risks. They need to be avoided. Even if it doesn't happen in 07, it happens in 08. It's going to happen eventually. The further out into the future it happens, the worse it's going to be. So people need to be prepared. They need to be invested abroad.
You're making the same mistake everybody makes. The dollars don't disappear. They may change ownership, but they don't disappear.
But the value disappears and their purchasing power does. And if you want to preserve your wealth, you got to invest abroad. And we're going to stick with the same thing.
Peter, I want to follow up with that idea, though, because it seems to me that it would be a mistake to think that, for example, emerging stock markets or foreign stock markets would be unaffected if the U.S. were to take it on the chin. It's not the way it typically works, and one would think that you would have bigger losses abroad if the U.S. economy were to slow down seriously.
That's a common misconception. I mean, first of all, you're going to immediately have a gain in the foreign exchange because the currencies are going to go up. But I think rather than being a positive force for the global economy, we're a negative factor because all we're doing is consuming what everybody produces and borrowing what they save. And if you take America out of the equation, Everybody else has a lot more money to borrow and a lot more goods to consume. I think the rest of the world is going to benefit from a sharp recession, provided the dollar plunges. If the dollar doesn't go down, then maybe what you're saying is true. But as long as the dollar collapses with the U.S., then I think the rest of the world is going to boom.
All right, Peter, tell us what you're buying.
Well, I'm still buying commodities. I'm still buying natural resources, mining and energy. And I'm buying very defensive investments for some of the reasons that Steve pointed out. We're buying a lot of utilities, a lot of commercial real estate trusts around the world, just very good, solid, high dividend-paying companies in Europe, in the Euro bloc, in Switzerland, in Australia, New Zealand, in Singapore, in Hong Kong,
Keith,
up in Canada.
Keith, real quick, what's your rebuttal to what Peter's saying?
As Peter describes this idea that the dollar has to fall and the foreigners are going to be the ones selling the dollar, I look at China as maybe the key factor here, and the Chinese currency is linked to our dollar. They're linked to our economy as well, and I cannot see China vacating and selling dollar at this point, nor can I see Japan doing that as well.
Amen.
All right, let's leave it there with that amen. Thank you very much, gentlemen, to you all. Stephen Abrams, Peter Schiff, and Keith Wirtz. I'll take your wagers. Send them in. Coming up next.